From the morning reading, bull flag set up, stocks start to bounce. 4 of 9 sectors moved higher and one was unchanged on Monday. XLV, XLU, and XLP were the strongest sectors while XLE was the weakest sector. Oil futures fell $1.32 to close at 43.24. Breath weakened as decliners led 1639 to 1416 on the New York Stock Exchange and advancers led 1369 to 1228 on the Nasdaq. Despite the rally in stocks, traders have been moving into leveraged inverse ETFs. Since the end of February, ETFs that have leveraged bets on a decline in stocks have added $1.3 billion in assets, even while the S&P 500 has gained 125 points. The history of these funds is limited, but there hasn't been anything like this in the past 5 years. They've also been trading a lot of put options. The total put-call ratio has been above 1.0 for 9 straight days, meaning more put options were traded than call options. There hasn't been a streak this long prior for the last 10 years, and since then, it has been clustered in 3 distinct time periods, as stocks were peaking in 2007, as they were bottoming in 2011, and over the past year. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Central Time, and I'm recording this in preparation for the market day of May the 10th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. And right there. Okay, there we go. Morning report. So, with all 4 U.S. broad market indices, they're slightly up, not enough to get excited about other than the Russell. The Russell's up about 0.2%. The other 3, the S&P, Nasdaq, and Dow, are all up just above scratch. Crude oil's down about 0.33%. Euro's down just below scratch. Bonds are up just above scratch. And gold is right on scratch. And overseas action, China is also on scratch. Hong Kong up about, just under 0.5%. Japan up large, up over 2%. Germany also up nicely at 1%. United Kingdom up about 0.75%. In terms of U.S. macroeconomic reports of note for today, you have the JOLTS job openings. And that looks to be about it. Looking forward to tomorrow, we have a 10-year bond auction, so you should pay attention to that if you're a bond trader. Crude oil inventories on the regular weekly report. And let's see. I don't see anything else of note for the United States. In terms of current volatility conditions, our volatility started to decrease. You see the 5-day versus the 10-day starting to drop. You have short-term VIX down below 14. Skew is benign. IV percentiles across all 4 broad market indices is very, very low. S&P at an 8, Russell at a 10, Nasdaq 15, and Dow at an 11. We now have had 4 straight trading sessions with no standard deviation moves on a close-to-close basis. So certainly very, very benign activity showing up on the volatility charts at this point. In terms of, let's go to the charts. We'll start out as usual with the S&P 500 charts, and you see we've had this consolidation pattern. We seem to have bounced a couple sessions ago, and that seems to be following through. But there is resistance in the very, very short term. So there's not a lot of room here either way for a good setup in terms of pot odds, unless you're an intraday trader and you're playing very, very short term, short target opportunity. So don't see much there of new information. Dow is very much the same picture. Nasdaq has also been bouncing and confirmed that bounce, though it's in the clouds, so that could lead to very choppy conditions. Russell also appears to be following through on something of a bounce. Question is, of course, if indeed this is a counter trend balance from a short-term pattern, then how far does it go? In terms of volatility, let's see what that's telling us. Things are getting pretty low. Let's go ahead and look at the regular VIX. In fact, I'll be stalking. If we can get a little lower, just a little bit lower, I will start stalking some opportunities to put some volatility trades on, both intermediate and long term. So that's something to kind of keep and watch for. And let's take a look at bonds and if they're giving us any indication. Now, this is kind of interesting. Notice how they came right up into the resistance. And remember, we painted this yesterday as an area of resistance. It's not a clean pattern by any measure. So basically painting this area between the two lines as the area of resistance. And we seem to be stalling right at that area. So that was one of the things that we said with the equities. They could kind of chop around and go into a neutral pattern. You see with volatility, you see with bonds, you see with equities. We're all kind of squeezed into a compressing area between support and resistance. So opportunities are, without major energy coming into the market, are probably pretty subtle on these markets right now. You're going to have to be patient in this kind of a market to see quality setups to develop. If you try to chase and overtrade in this market, you're just going to end up probably with not much to show for it. Let's see if anything is happening of interest on gold. Gold had a pretty significant pullback, though nothing really to say that until it gets down and breaks this diagonal or horizontal support area, and there's still quite a bit of room for that, that this is anything but a simple complex, or I should say a complex retracement and then a continuation to the bullish side. So not much on the charts today, so we're going to go ahead and move on. We do have a couple new developments on our daily report. One that has not changed is the market trend in intermediate term phase opinion. That's still phase 5, the in short term, the break of diagonal and horizontal support. In terms of our 3 market timing signals, IBD has these uptrend under pressure. Accumulation distribution score, the S&P is a C-, and the Nasdaq at a D-. GMI index did improve a notch to a 3 out of 6, but still retains a sell signal since May the 4th. The more sensitive GMI 2 is also a 3 out of 8, so not much encouraging there. In terms of decision point, no changes there. With yesterday's action, short term continues to be very poor looking, and the long term continues to be very, very mixed, with the intermediate still holding on to a bullish posture. So overall consensus between the 3 mechanical signals is a market in transition with very poor stack of time frames and ultimately a bearish bias. Position sizing opinions, no change from yesterday, 50% on the portfolio model, and on the active trader volatility based model, 75%. In terms of intermediate term market posture, we continue to deteriorate across all 4 of these indices. S&P and the Dow both below 40. Nasdaq severely bearish in the lower zone at a 12. And the Russell also continues to deteriorate. It's just barely above 50. If it drops below 50, it will also go strongly bearish. In terms of hedge warning status, still retaining level 1+, which is our caution level with an increasing number of warnings firing associated with it. In terms of special opinions, also no changes here. Option income strategies, the VIX is acceptable to initiate new positions for novice traders, and indeed, if this does turn into summer doldrums and tight sideways trading patterns, selling premium may be the strategy of the summer. At the same time, we say that obviously be prepared for increasing volatility at any turn. The most likely opportunity to get into trouble is to have this market break down, and trying to sell premium generally means for most people selling put premium, and that would be heating you up right away. So probably the best thing, bottom line, is to sell premium from the put side, but be prepared, have your position sizing ready for those adjustments because they could be in your future. In terms of covered calls and put selling, conditions are not acceptable to initiate new positions for novice traders. Either short or intermediate term bullish trades are basically nullified right now in the current market posture. More aggressive traders might consider using one-to-one ratios of in the money and out of the money. Also, if you're in an existing position and you wish to roll it out, you might also want to use a ratio of 1-to-1 in the money, out of the money. Also, you might want to become a bit more defensive with your low beta, high beta portfolio allocation. We had at one point gotten to be a bit more aggressive there, and starting to rein that opinion in. If you're put selling, these pullbacks can be very interesting opportunities for aggressive traders to put sell, but keep that position size with defined risk positions and position size in the scale you're willing to own. In terms of specific warnings, not much change from yesterday. We did have an increase in distribution day count. The S&P is now at a 7. Nasdaq is at a 9. If we see the S&P particularly go up to 10, we probably see IBD drop to a downtrend and their call on the mechanical signals. So keep that in mind. In terms of the current day, 10-day out, right at 40 area, intermediate term, intermarket risk aversion indicators, all 5 are still solidly with a risk off stance. In terms of sentiment, we did ebb off a little bit with extreme sentiment on stocks yesterday, though bonds and gold are both in relatively extreme patterns, so keep an eye on that. Fear and greed index is a 60, so a bit above neutral, and it's been hovering in that area here for a couple weeks. In terms of the intermediate term market posture by sector specific, you can see that that's a mess, with only utilities, consumer staples, and consumer discretionary with an up posture. In terms of all 3 time frames, only the 2 consumer sectors are holding up, and indeed there's probably more red than even neutral here. So this is decidedly not favorable to short-term or intermediate-term bullish swing trading or new positions. So might want to be patient on the initiation of those positions. In terms of percent change, you see here the 1 day, the 5 day, the 1 month, things are kind of sloppy, and the 1 month performance is fairly around scratch for the most part. So things have been very much going nowhere of late, and we may see more and more of that in the coming days and weeks. And I think that's probably enough for today. In fact, we had a bit of a long session yesterday, so I'm going to go ahead and be relatively brief today. We'll say one thing about the YouTube. If you would like to subscribe, we're closing in on another benchmark on our YouTube subscribers. This is free, but it does give you an announcement when content has been posted, so that can be quite helpful. And there's also, you just hit the little button there, it says subscribe when you're on the channel. And then a couple other things, there's some tools there that can be very helpful. You can get the resolution and the full screen set up the way you want. You should be watching these on high def. And once you get that notice that content's been posted, give it a couple minutes to finish processing and being available on high def. Playing back on high def gives you sharper images with the graphs and the like. Also, there's a speed button, and you can play this back at 1.5, and that'll generally take like a 20-minute video and play it back in about 13 minutes and still be, for most folks, very, very understandable and able to follow. Other opportunities, just hit the pause button, go to the hyperlink for additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the hyperlink down here at the bottom for the full set of disclosures. Otherwise, we'll see you back here tomorrow morning for the Falcon Global Market Preview. In the meantime, good trading.